Welcome back to Marginal Thoughts. Today we're tackling something you hear about a lot, especially if you're looking at business deals, property, or maybe startup investing SPVs.
That's right, special purpose vehicles.
Yeah, and that name, special purpose vehicle, it sounds, well, maybe a bit complicated, a bit intimidating.
It can definitely sound that way.
But today we're going to break it down. We want to get into what an SPV actually is, why people bother setting them up, and, how understanding them might even open up some doors for you, or at least help you feel more clued in.
Exactly. And the first thing to grasp, really, is that an SPV isn't some unique, complex legal entity you've never encountered. It's actually just a standard company structure. Think like a limited company or maybe an LLC, a partnership.
Oh, okay, so it's familiar territory, legally speaking.
Precisely. It's a normal legal entity, but it's created for, well, one specific job, a special purpose.
Hence the name. Got it. So it's not about the type of company, but the use it's put to.
That's the key. And crucially, it's legally separate from whoever sets it up, whether that's a bigger company, we might call a parent, or an individual. It stands alone, has its own finances, its own balance sheet.
And you mentioned LLCs or limited partnerships, sometimes called pass-through entities.
Yeah, that often comes up. In those structures, profits tend to flow directly through to the owners for tax purposes, based on, their stake in that specific SPV. But the main point is separate entity, specific goal.
Okay, that makes sense. Create a separate box for one task. But why? Why go to the trouble of setting up a whole new company for just one thing? What's the big advantage?
Well, the absolute number one reason, the real powerhouse feature, is a risk isolation. That's fundamental.
Risk isolation. How does that work?
So by putting a specific project, maybe an asset like a property, into this separate legal vehicle, any problems, any debts, any lawsuits related only to that specific project, they stay contained within the SPV.
Ah, so they don't contaminate the main business or your personal assets.
Exactly. They don't spill over. Imagine a businessman sets up an SPV for a new construction project and borrows money through that SPV. If, worst case, the project completely fails and can't repay the loan.
The bank goes after the SPV.
Primarily, yes.
Okay.
Their claim is mainly against the assets inside that SPV. Maybe the land, any equipment it owns. It shields the businessman's main established company and potentially his personal wealth from that specific project's failure. Litigation against the SPV generally stops there.
Okay, that sounds incredibly useful, especially for, well, riskier ventures. A firewall, essentially.
It really is. It walls off the risk associated with that single purpose.
Makes total sense. What else? Are there other big reasons people use SPDs?
Definitely. Another major one is making it easier for groups to work together on specific things, joint ventures and pooling money.
How so?
Think about, say, a few people wanting to team up just to develop one piece of property. It might be a one-off deal. They can create an SPV just for that single development project.
Instead of forming a whole long-term partnership for just one job.
Precisely. They each put their share of the capital into the SPV does the project, and then the profits from that specific project are divided up based on their ownership in the SPV. Clean, contained, time-limited if needed.
That sounds much simpler for temporary collaborations. And I know you hear about them constantly in the startup world too, right, for investing?
Oh, absolutely. Huge in venture capital and angel investing. FPVs are a really common way to pool money from several investors to back a single startup.
So like if a startup needs a big chunk of cash, maybe more than one angel investor can afford on their own?
Exactly that. Or maybe the startup just prefers fewer investors on their books. An SPV allows a group, maybe 10, 20 investors, to combine their smaller checks into one larger investment. They all invest into the SPV, and the SPV then makes the single larger investment into the startup.
Right, so the startup gets the funding it needs, maybe meets a minimum investment size, and the individual investors get access to a deal they couldn't have done alone.
Correct. And it also gives venture funds some flexibility. You might use an SPV to invest in a single company that's maybe a bit outside their main fund's usual focus area, or just for a specific strategic one-off bet.
And isn't there a benefit for the startup itself? Something about keeping their records tidy?
Yes. That's a really practical plus. It helps clean up their investor list, what's called the cap table, basically, who owns what percentage of the company.
Ah, I've heard that term, cap table.
So imagine a startup raising funds from, say, 50 individual angel investors, listing all 50 names on their official ownership records. It gets messy, complicated to manage, lots of signatures needed for things.
Yeah, I can picture that being a headache.
But if those 50 investors pool their money through an SPV, on the startup's cap table, there's just one entry. the SPV itself. It represents all 50 investors, but it's just a single line item. Much cleaner, much easier to administer. There are even specific types, like a founder roll-up vehicle or RUV, built just for this.
Okay, that's clever.
Mm.
So if I'm one of those 50 investors putting my money into the SPV, what do I actually own? Do I get shares in the startup directly?
That's a really important distinction. Usually, no. You don't directly own shares or equity in the underlying thing, whether that's the startup or a property.
Okay, so what do I own?
You own membership interest or shares in the SPV itself. It's the SPV as a legal entity that holds the shares in the startup or owns the title to the property. You're investing indirectly through that vehicle.
Got it. My ownership is in the SPV, and the SPV owns the actual asset. So if things go well, say the startup gets acquired for a good price, how does the money flow back to me?
Good question. There's usually a structure set up by the person who organizes and manages the SPV. They're often called the SPV lead or maybe the syndicate lead. A common setup, especially in venture capital, involves something called carry. Yeah, carried interest. It means the lead gets a percentage of the profits from the deal. But, and this is key, they typically only get that after all the initial money invested to the other investors, the limited partners, has been returned.
Okay, so investors get their original money back first?
Usually, yes.
Yeah.
Say an SPV invests $500,000 in a startup. Later, the startup exits, and the SPV gets $3 million back. The first $500K would typically go back to the investors to cover their initial investment.
Right, makes them whole.
Exactly. Then the remaining profit, the $2.5 million in this case, is split. A common split might be 80% to the investors, $2 million, and 20%, $500K, to the SPV lead as their carry.
So the lead is incentivized to make the deal profitable, but the investor's initial capital is prioritized. That seems fair.
It aligns incentives pretty well.
Okay, let's switch gears slightly.
Yeah.
How practical is setting one up, especially for something like property investment, maybe in the UK context, which was mentioned? Is it super complex?
Yeah. Actually, setting up a limited company in the UK to use as a property SPV, it's basically the same process as setting up any standard limited company. You do it through Companies House.
Ah, so there's no special SPV registration button on the website.
Nope. That's a common misconception. You register a normal limited company. You need the usual things: directors, shareholders, rules for the company called Articles of Association.
So could I potentially do it myself online?
You could do a very simple setup yourself, quite cheaply. But especially if you're going in with partners, or if you want to think about maybe more tax-efficient ways to structure things down the line using different types of shares, sometimes called alphabet shares, getting advice from an accountant right at the start is usually a very good idea.
Yeah, probably avoids problems later. What about defining what the company does? Is there anything specific there?
Yes, that's important. When you register, you choose a Standard Industrial Classification Code, a SIC code. This tells everyone the main business activity. For property SPVs, there are specific codes, like 68100 is often used for buying and selling properties, maybe flipping them. 68209 is common for letting properties like long-term buy-to-lets, and 68320 for property management.
So you need to pick the right code for what you actually plan to do with the property.
Exactly. It needs to match the SPV's purpose.
Any other really practical tips for setup?
One really useful tip that came up is about the initial shares. Keep the nominal value low, like £1 per share is very common. And maybe only issue a small number initially, say 10 shares or 100 shares.
Why is that?
It means the initial required capital to set up the company is tiny, maybe just £10 or £100. Later, when the SPV needs actual money, perhaps to buy the property, it's often much better for the owners, the directors, to put that money in as a director's loan.
A loan to the company from the director.
Yes, because money loaned to the company can usually be taken back out later, tax-free, when the company has funds.
Yeah.
Getting money out that was put in as share capital is much harder and can have tax implications, so loaning the working capital is often more flexible.
That is a really smart, practical point. Anything else?
Just the reminder to get a business bank account set up for the SPV early on. Banks can sometimes take a while, weeks even, to get accounts opened. You don't want that delaying your property purchase or investment.
Good advice. Start the bank account process ASAP. Okay, so we know what they are, why use them, how they work for investors, some setup tips. Let's look at it from the investor side again, especially in that startup and angel investing space. Why do investors like SPVs? What's the appeal?
Well, several things. First off, increased access. A hot startup deal might have a really high minimum investment, maybe $50,000 or $100,000, which prices out many smaller investors.
Right.
But an SPV pooling money might allow people to get into that same deal with maybe just $5,000 or
All right.
$10,000, sometimes even less. Kind of democratizes access to those specific deals.
Lowers the barrier to entry. Makes sense.
Yeah. Then there's deal transparency. This is a big one compared to, say, investing in a traditional blind pool fund.
How so?
With a typical venture fund, you give them your money, and you trust the fund manager to pick good companies over the next few years. You don't usually know the specific companies in advance.
Right. You're betting on the manager.
But with a deal-by-deal SPV, you know exactly which company you're investing in right now. You know the valuation, the terms, everything, before you decide to invest your money in that SPV.
So I get to assess the specific company myself.
Exactly. It becomes a learning opportunity, too. You could do your own research on that one specific startup before committing. Investors often really like that direct visibility.
I can see why. And what about the people running the SPVs, the leads? Why is it attractive for them?
For them, there's a lot of flexibility. They can choose to put together deals for companies they're really passionate about or where they have deep expertise without needing the structure of a full, diversified fund.
So they can be more opportunistic.
Very much so. And financially, as we touched on with carry, it can potentially be more rewarding. They earn carry on each successful deal, deal by deal. In a traditional fund, the overall fund performance has to be positive before carry is paid, and one or two bad investments can drag down the whole thing.
Ah, so the SPV model rewards individual successful picks more directly.
Potentially, yes. It allows experienced people, maybe former founders, industry experts, to leverage their network and expertise to facilitate investments without the huge overhead of running a full-time fund. And it lets them leverage their capital. They can invest their own money alongside funds pooled from others.
So lots of positives. Focus, access, transparency, flexibility. But it can't all be perfect. What are the downsides? What are the risks, especially for the investor putting money into an SPV?
The biggest one definitely is the lack of diversification. It's kind of the flip side of that focus.
Because you're investing in just one thing.
Exactly. That SPV holds shares in one startup or owns one property. If that single investment goes belly up, well, the money you put into that specific SPV is probably gone. All your eggs are in that one basket.
Unlike a fund that spreads the risk across maybe 20 or 30 companies?
Precisely. The risk is highly concentrated. Another point is limited investor control.
What do you mean?
As an investor in the SPV, you're usually what's called a limited partner. You provide capital, but you don't typically get involved in the day-to-day management of the SPV or the underlying asset. You're relying on the SPV, the manager, to make the right decisions.
So you don't get a vote on, say, how the property is managed or strategic decisions at the startup?
Generally, no. You're trusting the expertise and diligence of the person running the SPV, so you need to have confidence in them.
Okay, concentration risk and limited control. Good to be aware of. Let's just clarify a couple of distinctions again. We said an SPV uses a standard legal structure, like a limited company. How is that different from just a regular trading company, say my local bakery set up as a limited company?
It really just comes down to the purpose and the focus. The bakery is set up for ongoing trade, selling bread and cakes every day, indefinitely. A property SPV is set up for the specific purpose of holding and managing that one property, or maybe developing it. Its activity is narrowly defined. Sometimes an SPV might even have a defined endpoint, like once the project is finished and sold.
So same legal wrapper, different mission. And just to recap the difference versus a fund.
SPV, typically single asset, the specific deal up front. Fund, multiple assets, usually chosen by a manager. Over time, you invest in the manager's strategy.
Clear. And you mentioned earlier they're totally different from holding companies.
Yes, completely different concepts. SPVs for a specific project or asset. A holding company's main purpose is usually to own shares in other operating companies. It sits above them in a group structure, different roles, different uses. And those groups of investors using SPVs, often called syndicates. The syndicate is the group, the SPV is the tool they use.
Got it. Syndicate, people, SPV equals legal vehicle. That helps. So final thoughts. Why are SPVs seemingly everywhere now, especially in startup investing? What's driving the popularity?
Well, a few things seem to be converging. Setting them up has become easier and cheaper, particularly with online platforms that streamline the process.
Technology making it more accessible?
Definitely. Also, the clear terms of a deal-by-deal SPV make it relatively straightforward to explain the opportunity to potential investors. They know exactly what they're getting into.
Less ambiguity than a blind pool fund.
Right. And it's an attractive structure for people who are active operators, founders, execs who want to invest and bring their network into deals without becoming full-time VCs. Plus, That potential for deal-by-deal carry we talked about is a strong motivator for the leads running them.
It really does sound like they've hit a sweet spot of flexibility and efficiency for certain types of deals.
They really have become a very common and useful tool in the toolkit.
So, when you boil it all down, whether you're thinking about a property deal with a friend, or maybe dipping your toe into angel investing, or even just hearing the term, understanding SPVs really shows how these legal structures aren't just boring paperwork. They can be shaped for very specific goals, managing risk, pooling resources, opening doors. It kind of makes you wonder, doesn't it? How else could we apply this idea, this concept of creating a dedicated vehicle for a specific purpose, maybe in areas totally outside of finance?
It's a neat way to think about focusing resources and isolating risk, for sure. Lots of potential applications if you stretch the analogy.
Something to mull over. Well, that's our exploration of special purpose vehicles for today. We hope breaking this down has made the concept clearer and maybe a bit less intimidating.
Hope it was helpful.
Definitely. Let us know your thoughts or any experiences you've had with SPVs in the comments. And of course, please subscribe to Marginal Thoughts for more sessions where we try to make complex topics simple. Thanks for joining us.